At Metropole TVKE across all your social media platforms. My name is Simbalaja Charles Kiage. Welcome to your official economic review this morning. Let's wake up with the biggest headlines that you are going to run into as the day progresses today. Now, joining me in the studio is Abraham Mdhogo, the CEO of Miradi Capital. Abraham, how are you doing, sir? Karibu sana. Online, we're joined by Gabriel Amendo. Gabriel, good morning. How are you doing, sir?
Very good, Simba. How are you doing?
Fantastic. We can't complain. And later on, we do expect to be joined by Arnold Nkasale. All right, let's introduce the first story like this. And we're going to start by this story with Vincent.
After months of progressive increase in the cost of living due to historic high cost of fuel prices in the country, Kenya could be staring at a breath of fresh air as the government now intends to tame both power and fuel prices. On Thursday, Interior CS Dr. Fred Matiang'i met the Energy PS Dr. Gordon Kihalangwa and the Board of Kenya Power to deliberate on ways of implementing the recommendations of the Presidential Task Force on Review of Power Purchase Agreements. These recommendations are expected to cut the cost of electricity by as much as 8 shillings per unit.
We want to ensure that we address all challenges in the sector that result in the costs and all this being passed on to the consumers, because clearly our bills are unsustainable as they are today. We cannot continue this way. So we have agreed with the board on a very aggressive method of reviewing even the billing system at the KPLC to ensure that it not only passes muster, but it addresses some of these challenges that we have.
The Interior Cabinet Secretary also hinted at more reforms in the energy sector, saying the cost of fuel will be reduced in the next monthly review, days after the Energy and Petroleum Regulatory Authority Director General Daniel Kiptoo warned of further price increase due to global price of crude oil. With barely a week left until the next monthly review, this is a welcoming news, especially to motorists who have been forced to pay up to 134 shillings and 72 cents for a litre of petrol, 115 shillings and 60 cents for a litre of diesel, and 110 shillings and 82 cents for kerosene.
We have not only identified some of the systemic challenges we need to address, but we have taken steps, and you will see when the next review happens that as the result of the many actions that have been taken, you will see some reductions in the cost of fuel as we go forward. I mean, government never makes promises in vain. We've been working on this, and we've heard the cry of our fellow citizens. And we live here, we interact with our people on a day-to-day basis.
Asked on the ongoing boardroom wrangles at Kenya Power, CS Matiang'i denied the claims, saying he was not aware of any leadership issues at the board of the utility provider.
The board does not work on its own. The board works with the management, and the management are members of the board. They are represented in the board by the CEO. They work together all the time.
That's it. That's it. Specifically on that area for fuel, and we're going to talk about this morning. But now, let's introduce our end like this. It's now emerging that senior officials at the Treasury and the Ministry of Petroleum diverted 23.6 billion shillings meant for the fuel subsidy, a big factor that was behind the discontinuation of the scheme last month and pushed pump prices to record highs. Justin Muturi, Speaker of the National Assembly, indicated Tuesday last week that members of parliament would decide on the direction they would take over the matter when the debate committee recommendations on the pricing of petroleum products in the country. Now, the fuel subsidy that was behind the steady pump prices in the country was discontinued, a factor that saw prices of the commodity in the country rise to historic highs of 134 and 72 cents for petrol and 115 and 6 cents for a litre of diesel. Last month, Treasury found itself in an unfamiliar position when a request to have the prices of the commodity in the country stabilized was met with empty pockets at the Treasury, according to the Treasury PS Julius Muia. Now, oil dealers received 8.64 billion from the state in compensation for the 5 months that fuel prices remained unchanged, with motorists paying 5 shillings and 40 cents per litre to the subsidy scheme since July last year, after the Petroleum Development Levy was increased from 40 cents. Now, this comes after Interior Cabinet Secretary Dr. Fred Matiang'i hinted that Kenyans are likely to pay less for fuel in a week's time, just like you saw this morning. All right, Abraham. It looks as if we have a solution, but we have not been taking that solution. Now, let me quote Deputy President William Ruto yesterday. He says that the Petroleum Ministry is run by cartels, and that is why we have the high cost of fuel in this country. He continued to say they have answers. They can't sit and just say they can do nothing about it.
You see, we cannot pretend that we have just realized that the fuel is run by cartels. It has always been run that way.
Yes.
Because in any market situation where there are very few players, cartel-like market tendencies tend to set in, because the few people sit together and set prices.
Yes.
So that is a very normal trend, and that is bound to happen unless you increase the number of players. But what is worrying me about this is the amount of doublespeak.
Okay.
Treasury is busy diverting. Honorable CS Matiang'i is saying we are going down in terms of bringing the cost down. The head of EPRA is saying it's going up. So clearly, we are still not clear how we want to do this. Maybe as government, maybe they are where they want to go down, but the methodology is a bit wanting, because
yes.
This subsidy, how do they build a subsidy? They build a subsidy by taxing through the fuel levy. So what you're telling me is you take something from me, then you use it to caution me. The best thing would be not to take it from me in the first place. And I said it here. To me, the best solution would be, let's reduce the taxes that we collect on fuel.
Yes.
And just bring the cost of fuel down straight. Let the fuel companies add the margins that they want to add, because these fuels are up, mostly up because of the cost of the taxes and the levies that are being levied here.
Yes.
So if that was to come down, in fact, the consumption of fuel would go up, simply because of the elasticity of demand.
Yes.
So the idea that, and also remember, in any subsidy system, a subsidy system which you're withdrawing more than you're putting in is not sustainable. And as you can see what has happened, they touched a bit and it couldn't sustain. So for me, the whole idea is we need to rethink our fiscal approach to how we collect this and how much we collect. Let's lower the rate so that we allow the marketers to put in their margin, and also to cushion the fact that the global oil prices are going up. And see, that's part of the component of the fuel. So that if that goes up and these people put in their margin, if government lowers their level of the interest rate, the tax rate, sorry, then what will happen is the cost of fuel will go down. Once it goes down, the consumption of it goes up. And the sum total of how much tax they collect will probably be more than what they're collecting now.
Yes.
As a sum total.
Yes,
Yeah.
pretty much. Now, Gabriel, you hear exactly what Abraham is saying. You just gotta be taxation. You reduce the tax bracket, more people are gonna drive, more people are gonna use this product, and the sum total of the tax that you're going to collect on a lower bracket is going to be even more than what you are doing right now by overtaxing that product. But even before we get there, Gabriel, that right now we have a lot of tax forces that are looking into this area. The Matiang'i-led ministerial commission that was supposed to look into this issue. We do have the Senate House and the National House that are all deliberating on the cost of energy in the country. Gabriel, what's going on?
Thank you, Simba. I think first it's to note that the same people who created the problem are now trying to sort of run and I think the fact that most of this is coming from government and very little guidance or direction in terms of law is coming from Parliament.
Yes.
It's also very worrying in terms of what results can we actually expect from this.
Yes.
Now, of course, and rightfully so, a big chunk of these costs are really taxes. Yeah. And it's very unfortunate that they are still hiding around it. It's still taxes. So even the additional 5 shillings that they added to the cost of fuel is still a tax. It's still there even today. It is. So in short, if they were to even take away the subsidy, the fund that they created that takes 5 shillings from every liter, it's also a tax. You've also
Yes.
increased the cost. Not really surprising because if your government and one pocket is calling for more funds. Sorry, are you getting me, Simba?
Yes, I can get you. Yes, Gabriel.
Okay, so as I was saying is that the challenge is that government had funds from this subsidy program, sort of the cost stabilization program that they came up with, and
Yes.
they diverted the funds. And unfortunately, it's
But by
that
the way, Gabriel,
even to stabilize the price.
by the way, Gabriel, if I might jump in there, I remember when this was introduced, I spoke to you and you said that your biggest worry is that these funds they're collecting right now might not just be used for that specific purpose, Gabriel. You actually said it.
Yes, correct. And that was really something that we've seen with other programs. And
Yes.
we are not surprised that this has happened, as you've just mentioned. And it's going to continue to happen because we've seen it happen with parastatal funds. We've seen it happen with funds raised from various bonds through increases in what they're raising. So it's not surprising that the funds are diverted. Whether it's the sustainable thing to do is what we should be asking now. Whether running that subsidy program or that stabilization program is what we should be asking, whether it's something we want to do or we should just reduce the prices by that 5 shillings that they increased.
Yes.
Because if you take away the 5 shillings, immediately you've then cushioned everyone, and then use whatever you've already collected. If there's no way to replenish it, that's fine. At least you've saved us 5 shillings. When prices go down, you can then reintroduce the 5 shillings at a certain level. But then again, just to speak about something my colleague has said, unfortunately for products like fuel, the nature of the commodity is not that when you reduce prices, demand automatically increases. And it's not that when you increase prices, demand automatically reduces.
Yes.
Because we all need the fuel, whether it's for driving around. I don't want to say it has inelastic demand, but the demand is not the conventional one where, the price has a direct impact. I think there's a lag in how fast the change in price affects demand. So it's not really intuitive. It's counterintuitive in that government knows very well that they can still push the price up without demand shifting significantly. Demand would be affected by other factors, but price is not the very first one that would affect it, and they know that. That's why they tax such products ridiculously. But yeah, a few things need to be done.
Yes. Now, Abraham, let's also touch on Kenya Power because the overall cost of energy in the country as well. And I asked this question, Abraham. I mean, you hear Matiang'i saying, well, we've spoken to the PS Energy. It looks as if we have the way forward for this country in terms of the cost of energy. Why now, though, Abraham? We've cried since time memorial that the cost of energy in this country is way up there. And speak to me in respect to Kenya Power, Abraham. It's a company that has been turning in losses for the last 3 years. In fact, yes, they've not been turning losses for the last 3 years, but if you look at that profitability trend, then you will see that it has been falling. In fact, the last one up to the year ending DEC 2020, between 2019 and 2020, negative 362%. In terms of that profitability trend. Then you say, reduce power by 33%. Is that what we need now in this country?
See, me, I'm more worried about the how, because don't forget, the PPAs, and PPAs are contractual documents.
Yes.
And these are documents that have gone through a lot of rigor in terms of going through the Ministry of Energy, EPRA, Kenya Power, back and forth, very smart lawyers looking at those documents.
Yes.
They're 20, 25-year documents. So some of the prices we are stuck with. And if at all we want to reduce the cost of power, then we must do it, we must draw a line going forward.
Yes.
That the ones we are negotiating now have to conform to what we want.
Yes.
As we wind down the ones that are very expensive. So short-term solution, I would really be keen to see how they want to do that. Now, the other thing, because don't forget, with the PPA, it's a give and take agreement that I'm going to produce 40 megawatts of power. If I produce it, you pay for it, whether you're going to use it or not.
Yes.
If you don't produce it, you pay me for
Yes.
having produced it. So they're producing it, whether expensive or not, but it was signed for.
Yes.
So that's going to continue being paid. Because there's this argument that yes, KenGen is giving very cheap power. It is true. But it's also true that these other people also have signed to provide the power. So they have to get paid. And we all know we have close to 1,000 megawatts which are being produced, which nobody is using. That is also another fact.
Yes.
So those two put together compound the problem. Because again, on the other side, on the retail side, Kenya Power has a ceiling on how much they can sell power to us. So on certain PPAs, they are loss making. That is the nature. That is the truth of the matter as we sit here, and that is what is contributing to the to the falling profitability. So some PPAs are profitable, some are not. Net sum is that you're not loss making, but your profitability is declining. So it's just a matter of time before you go into the red.
Yes.
So as I'm saying, for me, short term, there may not be a short term solution to this. To be quite honest.
Yes.
But we have to review the ones that are on the table, and we have to decide whether we still want to sign more, because we already have 1,000 megawatts sitting idle. So as I'm saying, and it's good, this conversation is being held at board level, and now we have zeroed in on Kenya Power, even in terms of how they do the things, how they procure. So that going forward, this problem goes away over time, and we don't create any further problem.
Pretty much. Now, Gabriel, you hear the concern by Abraham this morning is that, well, short term. I mean, when you're looking at Kenya Power right now, what they need to do is a short-term solution. It's got to be long-term, because it's also identified that where they are getting that knock is from the PPAs they've signed. Some of them that are running into 10, 5, 6 years, and you're saying that as from December this year, Gabriel, that's what we were promised, we're going to pay less for the cost of power. And the judgment was that it's going to be reduced by 33%. Are we essentially saying Kenya Power is going to be run down? Is that not it?
You know, sometimes these promises that the government makes without thinking through things really annoy anyone who's understood how KPLC actually operates.
Yes.
One, those are not things that can actually happen, because remember, KPLC is not only a publicly listed entity, KPLC also has international lenders and financiers who expect it to meet its obligations in terms of repaying debt and a lot of those other factors. So those are not people who would even entertain such ideas, and there's a big problem there.
Yes.
Two is that if you look at the PPAs, these are watertight agreements, because people have invested billions in those power plants, expensive or not, criminal or not. Billions have been invested in those various power plants. And there's a reason you have that arrangement where you first pay for capacity installed, whether you're buying power or not. Yeah, KPLC pays for that capacity installed.
Yes.
Then you pay for the power purchased, because they have to recoup their investment in one way or the other. Now we're talking about other lenders to those power generating institutions. So, and most of them being international, I would expect. So you're also risking the people who financed those projects, and I'd not be surprised if our banks are also exposed in a way. You're risking depositors. So there are a lot of factors to be considered in this. I think if they can resolve for whatever they want to term as fraud within KPLC, that would save quite a bit. If they can generate whatever system efficiencies, that would save a bit. But 33% was a bit ambitious, because one, terminating PPAs would be very expensive, because then you would have to pay those people quite a lot, or otherwise you end up in court again, and no investor is going to lose their money. Two, if you ask KPLC to reduce how much they actually keep, then what are you saying? You're saying that KPLC can no longer meet its obligations. KPLC as is already overusing overdrafts. You know, an institution which collects money upfront from you and I before using power, and collects its money within 30 or 60 days from most of the other institutions, is using overdrafts. It tells you that it's in a very dire financial position, and it's a very important institution. So if they push KPLC to a point where KPLC cannot maintain its network, we're going to end up in a situation like Nigeria, where you find 2 years later, we're shutting down an entire region for 8 weeks because KPLC now has to do a massive maintenance in a region ago instead of doing the monthly or yearly programs that they have for maintenance. So it's a very risky exercise. They have set ambitious and unachievable targets from where I sit. And I hope they do not bring the characteristics we've seen of breaching the law and acting as if there's no rule of law in some of these things in trying to bring this power cost down, because they're going to be counterintuitive and we're going to end up incurring more legal cost and waste time without any reduced cost in the long run.
Ooh,
That's my take, Simba.
It's for us to wait and see, because EPRA is coming in with another review. By the way, you've run with this high cost for 1 month now. If you don't forget, they're coming in with the next review, and we're going to see exactly whether Matiang'i and the president's promise is really going to stick or not. And by December, you're going to, according to the president, pay less, 33%. Whether it was a roadside announcement or not, it's bound to be sent. Now, let's move on to the next one, where Absa Bank Kenya has seemingly broken a Central Bank of Kenya law that limits amounts lent to one borrower. Now, the bank lent East African Breweries Limited, EABL, a total of 18.8 billion shillings, breaching the limits placed on lending to a single borrower at a time when it had a core capital of 46.3 billion as of June, with this data meaning that the lender should not have given out more than 11.5 billion to one entity. In an interesting twist, the breach became apparent after the brewer disclosed the credit it has acquired from the lender, which was totaling 18.8 billion in its latest annual report for the year ended June, equivalent to 40.6% of its core capital. Now, the single obligator law states that a bank must not lend more than 25% of its core capital to one borrower or related borrowers in an effort to reduce the risk of a bank failure due to defaults on a few big loans. And in a statement to the Business Daily, Absa Kenya diverged from the disclosures by EABL and suggested that it only provided part of the loans without specifying its exposure to the brewer. Now, banks are regulated by country level, meaning that Absa Kenya's capital is required to keep up with its lending activities, even if some of the loans it was disbursing represented funds sourced from its affiliates in other markets. EABL's newest loan from Absa Kenya is 11 billion shillings facility, which took the lender above the regulatory limit. Now, the loans Absa Kenya disbursed to ABL include 11 billion unsecured facility, which matures in 2022, July, and has an interest rate of 10.3%, 4.8 billion shillings extended to the brewer without security at an interest rate of 8%, and another 3 billion maturing in December 2026 with an interest rate of 8% secured by the brewer's parent firm, Diageo. Now, this is interesting though. In its recent filing though, the Central Bank of Kenya mentioned that 9 banks violated Section 10, Cap 1 of the Banking Act as they exceeded the single obligator limit of 25% of core capital. The regulator, though, did not mention the specific names of the banks. All right, let's look at exactly how Absa has been performing, and we're going to start with the first 6 months of 2021. And important to note that they actually did clock in a profit after tax and exceptional items. Now let's cross over to the next one in terms of how they performed. 2019-2020 profitability trend. Yes, we expected that profitability trend to drop in 2020. Let me introduce the conversation. Arnold Gsale. Arnold, good morning, sir.
Morning to you, Simba. How are you?
I am fine, thank you very much. Let's look at that. Should you be worried at a time when the Central Bank of Kenya is telling you that 9 banks breached that single lend obligator law?
Thank you so much. I think the conversations around lending, quality of loan books is has essentially been amplified during this season of COVID-19. And I think the dilemma most banks find themselves was who do you lend to, and
Yes.
how do you preserve your position as far as the quality of the loan book is concerned?
Yes.
I think most banks found themselves concentrating on what they would call their AAA clients, and trying as much as possible to have those clients continue to be serviced so that the quality of the loan book is not eroded. What you're seeing with Barclays is a situation whereby I think most institutions during this season, there's that particular aspect of how do you manage your NPLs? At the same time, how do you manage your clients who you know if you support, you will assist in protecting your asset base.
Yes.
So you find situations whereby you're trying as much as possible to find multiple solutions to your AAA clients, and in that process, you find yourself probably breaching aspects to do with the single obligor. I think the situation with ABSA and East African breweries probably falls along those lines. Now, the problem with that is when you do that, you have aspects to do with concentration risk as far as your loan book is concerned, and you actually turn your AAA client into a liability rather than an asset, because in the event something happens, you have a massive erosion of your loan book. Now, that being said, I think regional banks try to cover their position, as you mentioned, by having sourcing of funds and packaging of those assets in clever ways, which would essentially either have your client have a special purpose vehicle, whereby you would lend to a special purpose vehicle,
Yes.
and essentially just divide that particular exposure, or source funds elsewhere. But there are some instances whereby, as a bank, you'd probably have to syndicate or get special permission from the regulator, either to syndicate or to break down the facility into tranches which would not affect your single obligor. I think it's just a matter of how EABL was revealing its assets and liabilities that came to light sometime last week, and that conversation of single obligor came about.
Yes.
I think that's what most banks are ailing about. The idea is to just try and package how you do your credit facilities to your AAA clients. I think during this period, we've seen a lot of businesses suffer because of aspects to do with COVID-19 and the general aspect of the economy. So how do you package yourself in terms of the solutions which you're offering to your clientele? It's a dangerous position as far as banks are concerned. If you hear about 9 banks which have already breached that position, then it means most banks are trying as much as possible to sort out their AAA clients, and that
Yes.
is what is bringing about these situations. You're hearing about ABSA giving unsecured facilities to East African breweries because of what they feel that East African breweries has a strong balance sheet, as a regional presence, and they feel that if they can offer solutions to them, then that would probably protect their asset base. But let's feel that it's banks trying to maneuver through tough economic times.
Yes.
Mike.
Fantastic. Now, Abraham, a law is a law. And we have a man sitting in that office called Dr. Patrick Njoroge, who's been the best central bank governor for what now? Twice consecutively. He's been awarded as the best one. So let's look at it from that perspective. He's sitting there, and then he's saying 9 banks have already broken a law. In respect to COVID-19, should we just let them break the law?
I think we should address as to why that, if at all that law is broken, why is it broken?
Yes.
There are various possibilities. And one of the possibilities that I see him allowing it to happen, or giving it time to be corrected, is if a loan grows into breach.
Yes.
You lent it when it was at 20% of, let's say, for argument's sake, if it was 20% of your core capital, and due to the deterioration and the moratoriums, it crosses over.
Yes.
That can happen. So you did not lend more, it grew out into breach. Secondly, every quarter, and I think now it's now monthly, banks submit 5 returns, PR1, PR2, PR3, PR4, PR5. One of those documents shows the top 50, your top 50 debts are listed in order of size.
Yes.
The top, the number 1 to 50. So it is not possible that CBK did not know. First of all, we are talking about what Business Daily said. You see, so we do not have the full details. And secondly, I don't want to imagine that that the breach is to that level, because we're talking about 18B versus 12B as the limit.
Yes.
Remember that if you're the head, if you're the lead syndicator in a debt situation, you're the one who collects the entire payment and then you break it to each of the people. Now, whether it's a reporting issue that shows that they're the ones in the control of the entire amount, then chunks it out.
Yes.
Whether with local banks, whether with their parent company, those are details we do not have.
Yes.
So whether we are probably worrying about something that has not happened, or has not happened to the extent with which it's coming out, for me, I find myself constrained, because the details that I would want to see is one, what are the breakdown? And you see, the bank was very clear. That is none of anybody's business. It's between us
and
EABL.
Yes.
Then secondly, this story has come all through and CBK has not said anything. So all those things put together tells you that there's a side of this story that we do not know. But be that as it may, the 25% rule is a very serious rule, because it is the law. Actually, it is a law.
Yes.
So when you breach by growing into it, then what normally would happen is CBK would give you a period to comply, because you did not give out that money, it just grew into you, and given the circumstances which has happened.
Yes.
But if you are to dish it out, then they would pick it in the next return you'd do. So they would act at that point.
Yes.
So I want to believe, whatever the case, CBK is on top of it, number one. And number two, appropriate action is being taken.
Yes.
And for him to admit that 9 of them were in that situation, it means that they were managing that situation for whatever the reasons it had happened.
Yes.
For the simple reason that banking is a confidence business. There's a way you can react and bring the whole industry coming down. So all said and done, whether there is breach or no breach, the person to call it at the end of the day is the Central Bank of Kenya.
That's it, isn't it? Yeah. All right, now, Gabriel, just 2 minutes before we take a short break. Abraham may want to look at it in different ways. Fine. Abraham may look at that number and then say, that's a huge number, and he doesn't think that the Central Bank of Kenya would sit and not get on top of that situation. But then, Gabriel, we only learned of this when EABL was giving us their books. That's the only time it came out. And that's when APSA gave us a statement. What do you read into that, Gabriel?
I think from where I sit, I mean, nothing is certain in this world, but I want to put my bet on the fact that APSA did not actually breach that law. And that
but is that true, though, when the Central Bank of Kenya is telling you 9 banks are already in breach, but we're not going to tell you which banks are those?
It's not going to be APSA, because APSA has, like I think has been mentioned, they can syndicate, they can book those loans in the South African entity, in other subsidiaries, and that's what they normally do.
Yes.
So for EABL will be dealing, yes, with APSA Kenya, but those loans do not sit entirely in the balance sheet of APSA Kenya. I've dealt with several banks in this country, and that's one of the laws they're very careful about.
Yes.
And they are careful to the extent that they do not look at one company. So even if EABL had a subsidiary, they would look at the total loans they have given to EABL and its subsidiaries.
Yes.
So I'm almost certain a bank like APSA would not be in breach of such a law. It's just, I think, I'm certain.
Gabriel, they have a 4 billion facility to EABL without security. They do. I mean, it's in their statements, Gabriel. When you read into that, would you not also suspect then?
I know it's... Yeah, so I think it's just a case of maybe slightly not accurate reporting from EABL, because you see how EABL will view it as the customer.
Yes.
It's more simplistic. You know, we're dealing with one bank, and this is this is the most obvious loan, rather lender we're dealing with. But
yes.
If you look at how that loan is booked, it's very different. And in terms of security, I'm sure that there could be, even if it's unsecured, then either it's an open line, either an overdraft or something. But you know, really, the structuring of those would be top tier.
All right, gentlemen. Once we come back, we take another round then and ask that question. When you see banks like APSA now being quote unquote in contravention of that law, was this sort of lending necessitated or brought about by the effects of the coronavirus pandemic. And that's exactly what Arnold was alluding to, that you are only looking at your AAA clients. Is that why APSA was quite willing to extend it to EABL without taking so much care into that law once we come back here on a business hour?